Hey everybody, welcome back to another edition of Market Talks with DrStoxx, coming to you live from the live trading room of DrStoxx.com. That's DrStoxx.com. And if you want to join us throughout the trading day, lots of great discussion going on. I share my views of the market every few minutes and what's moving, what's not. I share everything I'm trading. So if I get into a new position, I tell you my entry price, my stop loss, my target price, the reasons for the trade. We've got a big group of people who are at all levels of trading experience. If you want to join us, click on the subscribe menu, scroll down to the live trading room. You can add on the brand new live options room, brand new as of now. It's 4 months old as of yesterday. Brand new options room for a discount. You can subscribe to both rooms. Both rooms are just on fire today, absolutely on fire. And we're going to look to make it a bit more hot, a bit hotter. All right, I don't have much time, so I only have about half an hour with you guys today. I'm going to jump over to the options room and do another half hour there, and then I'll wind up with the last hour of trading together. Let's get over to some charts. So let's get right into it. This is we want to start with some index futures contracts here, and this is the S&P 500, the daily chart. You're getting overnight data factored in here as well. So it's not just American trading; it's European and Japanese trading and everything else. And we had a really nasty day yesterday. So yesterday, the market opened a little bit down, rolled a little bit higher, and then it was just a big slam from about 1 o'clock in the afternoon into the close on heavy volume. And the trigger was a very bad bond market auction. And it was for the 20-year, right? If you're auctioning off the 3-month bond and it doesn't go that well, okay, nobody's that concerned. But when it's a 20-year time commitment, right? People are saying, yeah, I'm not going to tie up my money for 20 years and take on that kind of risk because it's not worth it. With bonds aren't well backed by American credit. So we don't have a good view of the American economy going forward 20 years. We're not going to buy those things. Or if we do, we're only going to do it at a higher yield because we want to be well paid for our risk. So that's what happened yesterday. Market didn't like it. Market sold off. We had a lower this morning right off the bat, pre-market and right off the early bell. There was an early bump and then it was back down again. And then it's been just a nice trend up day ever since. It hasn't been huge. We're not retracing the whole thing of yesterday's fall. There was a little bit of fall on Wednesday as well, or sorry, Tuesday, when things kind of started. And so it's not going to come back overnight. We'll probably get a few more days down here just above the 200 period moving average. But I tell you what's looking like it is forming here is a bullish, and this is very bullish, inverted head and shoulders as a bottoming pattern off of the tariff crash. Right? We had a tariff crash in late March, early April after testing new all-time highs, and the market has been in recovery mode ever since. Now, let me give you a couple little tips here in this chart. You've got some downtrending things going on, right? You've got the LRC, the linear regression channel, falling lower. The 200 period moving average now is starting to tail higher, but it has been falling. The 21 period moving average has been rising for a while, crossed over the 50. The 50 is starting to tail higher. All that's good, but we still need to see the 50 get above the 200 and the 21 get above the 50 and the 200, and we're not there yet. So all this is saying is that we are still in a technical downtrend. However, technical downtrends, let me see if I can get a marker going here. Technical downtrends tend to go like kind of like this, 45-degree angles, shallow relief rallies, 45-degree angles down, shallow relief rallies, 45-degree angles down, shallow relief rally. That's how they tend to go, you know, on an average basis as they move lower, lower highs, lower lows. When you get a relief rally that looks like this and breaks out over the previous pivot high, that can be, it's not always, but it can be a really good sign that you're no longer in that downtrend. You are now, in fact, in a new uptrend. So that's what we have here, right? lower low, lower high, lower low, lower high, oh, higher low, and then boom, almost a vertical rise, much steeper than 45-degree angles on the relief rally to the north. That's this pattern right here, not this pattern, right? This pattern suggests more downside ahead. This pattern suggests the worst is behind us and it's time to start buying some stocks. Okay, so we've been buying stocks for a couple of weeks now. All right, let me get rid of all this. Get rid of all that stuff. Okay, so possible, not confirmed yet, but possible inverted head and shoulders. And this head is so deep compared to the neckline, which is up here, right? The target price for this is the bottom, the closing lows of the head, all the way vertical up to the trend, the neckline, and then you add that on top of the neckline at the point of breakout. We're not at a breakout yet. We haven't printed the right shoulder yet. I suspect that the move we just had, 2 days down, a little bit of a relief back up, and we're probably going to get some choppy give and take back and forth, particularly if we see yields start to creep back up again. They're down in the red today, and that's very good. Down about 1%. We want to see that. We want to see yields fall. But if we're not out of the woods just yet. But I have to say that today's market is making all the right moves. We're seeing bonds strengthen. We're seeing the leaders lead. And we're getting a little bit of traction now. We weren't earlier, but we're getting some traction now in small caps and biotechs and speculative names. We're in the quantum computing space, and it's really doing well. So there's some good appetite for risk out there. Yeah, really good. So all that's good to see. That's the S&P. We're in a little day trade in the MNQ Micro E-mini, and we're doing okay so far. It's getting close and close and close to our target price. It got just a little bit below our target price while I was away at lunch. Probably would have taken some profits near there if I had been watching it, but I wasn't. So we'll hang on. We're moving up our stop on that. So similar kind of pattern here, right? Here's your left shoulder. Here's your head. The right shoulder, I'm not quite sure where that's going to be. It could be up there, could be forming right now, or it might have already formed if that's the right shoulder. If that's the right shoulder, that would be a really nice looking inverted head and shoulders. Why is it nice looking? Well, the neckline is mostly flat. The right shoulder, if that's what that is much smaller and shallower than the left shoulder. You want to see that. You've got a nice deep head, which flushes out all that negativity and weak hands and gets traps the bulls on the way down and the bears on the way up. And it gets everybody frustrated and angry. That's what the market does. And that's always a very good time to get back into the market, not stay out of it. And it could well be that the NASDAQ has already broken out of its inverted head and shoulders. And the inverted head and shoulders is your second strongest trading setup for reliability, right? So once it does break out, it confirms the breakout, it more often than a lot of other patterns goes all the way to the target. Your number one target is your high tight base, so a rectangle pattern at the top of an uptrend. When it breaks out to the upside, right, new all-time high or 52-week high, that's your most bullish pattern, but this is second. Maybe cup and handle is kind of tied with it, but they're very similar, and it's, always good to pay attention to that kind of pattern. I don't do a whole lot with patterns, but those I pay attention to. So MNQ, the downtrend is not quite over, but we've got some good stuff going. First of all, the 21 is not only above the 50, but it's also above the 200. The next step is to get the 50 back over the 200. The step after that is to see the LRC start to flatten out. Right now, it's still slanting down. We want to see it flatten out and then start to tip to the north. And we're not there yet. The other thing I really like about this is that we've got all this bullish volume balance, big green sticks, bigger than reds, more greens than reds. People are accumulating shares from this higher low all the way up. Right? This is not people, day trading and getting out and then going short or putting on hedges. These are people that are buying and holding, right? Because the volume numbers are high and they're leaning bullish, and that's a good thing. Now, of course, we could get Trump coming out tomorrow or tonight and saying, I'm going back to 145% tariffs on China, and I'm totally canceling all the deals with Europe, and we've got nothing going with Canada. He could really throw a curveball out there, but I don't think he will. I think he's gotten some wisdom and he's got some good people around him helping him. And every step he's made in the last couple of weeks has been on the de-escalation side, not on the re-escalation side. And that's why the market is rising higher. Okay. Market's worried about tariffs, worried about inflation, worried about a hawkish Fed, worried about slowing growth, worried about a weak labor market. And you know what? None of those things are happening. None of them. The only thing that we have to worry about, and I think we hit the peak yesterday, is that nobody wants to buy our bonds. Nobody. Okay, so here's what the Fed can do. The Fed can step up, and they've been tapering their quantitative tightening. That's a good thing, but we want to see them start to buy some bonds back. And they should, if they're smart, because they're at such a low level. We haven't seen these lows since 2007. That's a long time ago. Now, if you remember, 2007 led into 2008, one of the worst bear markets in market history, certainly in my lifetime. And we don't want to go through that again. But here's some good news. That was a horrible crash that affected mainly banks and the housing market. And that was because we had a lot of economic structures that were very risky, and people made a lot of money from them, but ultimately made those institutions very vulnerable. We've had new legislation since then. Those things can't happen. And so we're in a much better place. Plus, the economy has grown huge since then, right? Probably 10 times as big as it was. Well, maybe not 10 times, 3 or 4 or 5 times as big as it was back then. So should bonds be at 18-year lows if the economy has grown over the past 18 years? No, of course not. So deep, undervalued space right now is bonds, and we'll get to that in just a moment. So small caps, you always want to see small caps have a good day because that means there's a risk on appetite out there, and they were very weak this morning. Kind of looked like they were gonna break down again and roll back down. And if you're looking for a downtrending market that looks like it just wants to fall over again and fall down to the lows, it's this one. You're not seeing the kind of vertical momentum on the price side here as we did with S&P and NASDAQ. So we would need to see this space come back online, and here's some very good news. Moving averages are starting to do what they should do. We still need to see the 200 start to at least flatten out, but the 50 is just, if you can squint, you can see a little bit of a tick up. 21's above the 50, and it looks pretty good. Volume balance down here. It's a bit on the mixed side, not as strong as we saw with an S&P, but it is leaning bullish. That's good. And look at this pattern. This is a perfectly formed inverted head and shoulders. All we need is for it to close above that neckline up there about 21.25, and we're not there yet. We're at 20.55. So another 75 points of movement to the north. And look, we've got a hammer candle today at the rising 21 period moving average after a big sell-off. That's not a bad place for people to start bidding the small caps higher. But we want to see that. Now, Bitcoin is up at all-time highs. It is a safe haven space. It looks very good. Looks very good right here. And we're long Bitcoin in both rooms. We're long IBIT calls in the options room. We're long shares of IBIT in this room. And we're just riding it out and enjoying the ride. I actually moved our IBIT target up to 90. So we should be okay for the while there. 10-year yield is falling. We want to see that crash. We wanted to see it go down, and we want to see the dollar also show a bit of weakness. Where is it? No, that's not. That's UUP. There it is. So it did roll over a few days ago. Yeah, let's just see it kind of linger down here in this area without getting too strong. Look how weak the dollar has been, and that is good for gold. It's good for Bitcoin. It's good for especially smaller cap companies that like to see their products get cheaper from buyers abroad. and all of that is coming up. Solars are in a world of hurt today because the bill that just got passed. I'm not sure it's passed the Senate yet, but the big beautiful bill, big, big beautiful bill is really not very good for solar companies, and I'm not sure where they come out on with EVs, but we'll see where that goes. Okay, let's take a look at some mags. Not all mags are created equal, and we've got a few in here that are not doing so good. Apple is still a no-go zone for me. I like that it's reversing today, but it's still red and it's still in a downtrend, and there's not much to pin your hat on if you're hoping for a big move higher in Apple. It's just not the one you want to be in right now. Own shares for years, fine, but for a trade, much better setups out there. Let me show you a few good ones. You're going to see bull flag, bull flag, bull flag, bull flag. It is the pattern of the day, and it is, again, like the inverted head and shoulders, one of the most bullish patterns. Look at this vertical move higher. Vertical, 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 vertical. This is Facebook. Pull back. And yesterday, when the market was falling heavy, Facebook hardly budged. Hardly budged. And it's a good looking green candle today. Volume balance in the recent trade has been good. This is a buy. It's a buy in my book. We're not long Facebook, but I wouldn't kick anybody if they bought shares today. So Microsoft is a little toppy. I wouldn't want to get in, but I have to say there was a massive $20 million bet placed on Microsoft for, it was either December or January, and it was at a strike. These are calls at a strike a good 20% above current price. I don't remember the strike. It was 475, 480 with time going out to January, December or January, I forget. So that's a big bet, and you're not going to make that kind of bet unless you think Microsoft is up and up and up from now to the rest of the year. So it's got to go up 20% for this guy to even break even, right? 20% higher for him to break even. I don't know what the premium was, probably not a whole lot, but it still needs to go higher for him to start making money. I really like NVIDIA. It's another vertical rise, good volume balance. MAs are starting to do what we want them to do, all turning higher, and it is a bull flag. We're long NVIDIA. We're long NVIDIA calls in the options room, and we're long in the wealth building portfolio in the live trading room. Amazon, nice looking. We're long Amazon shares, AMZU, the leveraged version, in the live trading room, and it is a nice push off the rising 200 period moving average. Bull flag, bull flag, bull flag. The thing that I like about this, it was a massive gap up on the China news last Friday, over the weekend, I guess. And or no, that wouldn't have been the China thing. What is that big gap up for Amazon? Because it's not earnings. I don't know. Maybe it is the China gap. I'm just getting the days wrong. Anyway, big gap up. It hasn't closed the gap, and with the market being really weak the last couple of days, it's not too bad. Holding the 200, this is the kind of thing that starts to end the downtrend and create a new uptrend, and that looks really good. Google was doing great, and then it broke out this little tiny range right here. It's got up today above the recent pivot high, got up above the 200 period moving average, and then it came out with some bad news. After all that enthusiasm, came out with some bad news right at the peak. Right, it was up above 175. And it just dropped about $3 in a matter of minutes. So it's going to get a little squirrely because I don't think the news is going to be material going forward, but it will create, some concern for Google, some headwinds over the next couple of weeks. So to me, I've long been saying Google's a no-go zone because it was underneath all this resistance down in this area. It had this big red stick. It did come back, but then it just didn't look that healthy, but the last two sessions, very good. And we're in breakout mode. And despite what happened today, it's back on my go zone. It's not a no-go zone anymore. I like Tesla, and we're long Tesla in both rooms. We have TSLA calls in one room, and we have shares in the other room, or is it vice versa? I forget. Anyway, Tesla. It's not the vertical rise that we're seeing. So that's the one concern, but it also didn't do the big drop down in April that the rest of the market did. So, okay, we can give it a little bit of space. And, it's got some political headwinds. It's got some China problems. It's got tariffs I don't think have been fully factored in yet. But I really like this bullish setup, right? It's a rise higher flag, rise higher flag. We should see another good leg higher. And 420 is probably about where the next move will go. And that's a good pump from here. All right, let me go through some stocks on my greens list. We're doing fine on time, keeping disciplined to my mouth because I do when I'm talking stocks, I tend to just get really carried away. All right, so let me go through some of these on the list. Some of these are Bitcoin related, some are tech, some are speculative names, some are recovery plays. So they've been down, 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 and finally starting to reverse higher after hitting a support zone. I'll show you some of those. A little bit of everything here. We're long HUT in the live trading room. We're long calls of Mara, similar play in the options room, and both look really good. So it's a soft recovery move, but I like the fact that it's been consolidating sideways, not pulling back, but consolidating sideways, and then a nice move higher, consolidating sideways. I think the next move is going to be higher, and so far so good for that. BULZ is a good way to leverage the whole group of mags in the top tech stocks. About 15 stocks in there. They're all equal. I think they're equally weighted, and it's a 3x bull fund of those stocks. So we kind of nibbled on some shares. We came very close to our stop yesterday on the big flash crash, and it's back up today, and it looks pretty good. The mags. I'll show you real quick. I should have done this earlier. But if we go to the homepage of FinViz and we look at the heat map, it's a lot better than it was. But the only greens that you could see this morning were up here in the northwest quadrant. All the mags, everything else was red to deep red. You can see the market starting to get some breadth coming back in, and that's good. We want to see that. We want to see breadth. Breadth is good. You don't want bad breadth. That's an old trader's joke. Okay, back to our charts. Here's Mara. It's going to look a lot like HUT. It's a little bit of it's not as robust today. It was up nicely earlier. We'll have to keep an eye on that one because there is some distribution going on here. Amazon, we looked at ARM. Okay, let's look at bonds. So this is very good sign. If you look at the monthly chart, which I posted in the room last night, I think it was. Here's the monthly chart. It's just been down, down, down. It's been in a horrible bear market for several years, right? It topped out in just after the COVID crash, just after the COVID crash, and it's been downhill ever since. That was 5 years ago. Hasn't had a good year since, not at all. But here, these lows down here around 84 are matching lows that we haven't seen since 2010, 2011, and I think the bottom of that thrust, I could be wrong. No, I'm sorry. Not these lows up here. We can see this little red line that matches the lows here in 2007. 2007, just before we got into the bear market. Of course, bonds tend to rally on a bear market. Does that mean we're heading into a bear market if the bonds start to rally? No, not necessarily. We want to see yields come down. We want to see money supply get very much more liquid, and we want to see lending costs come down. And all of that will cause bonds to go up. So, let's get back to the daily chart and talk about what's going on today. We've got a nice looking, this is a bullish piercing candle, which is a candle that starts out low, below the low of the previous day, and prints a little bit maybe of a tail there, and then rallies up to close within the body of the previous day. And that's exactly what it's doing today. It could be considered a flush out bar, which is to say, when it opened up this morning and it was down again and everybody was plowing into bonds over in this area and over here, and then they're just going to throw the white flag in and sell, and then pretty soon everybody's out. Everybody that wanted to get out of bonds are out of bonds. Everybody that wanted to short bonds have shorted bonds. And now it can only go up, right, from here. So technical bounce, it's all I'm looking for right now until the economic macro changes. But volume shelf, really thick volume shelf that goes all the way back to 207 to 202 and beyond. I don't think that support level, let's call it 84. Let's call it 8350. I don't think that support level is going to get violated. I would be very surprised, and it would have to involve some changes in the economy. PLTR, one to keep an eye on. It is looking good again. Nice little soft pullback. Had an ugly day yesterday, but it is printing an inside day bar off the 21 period moving average. This is about one of the strongest charts in the market right now. It is a leading stock. If it is happy, the market can be happy. And I don't have shares myself. I wouldn't mind getting in today, but we've also got a lot on, and we've had some volatility. So I don't want to get too heavy. But if I had to buy, if I had space, and I had some cash, I wanted to put it to work, this is where I would put it. Let's see, Oracle is looking pretty good. If bull flag just under the 200, a little bit of work to get above that, but it's not there, and it's getting there. CVX is a recovery play, right? We were in this one over in this area, caught a little bounce, I think it was, or was it another? Anyway, we played one of the what do you call it, the pumpers a couple of weeks ago for a small gain, and now it's setting up again. So pull back, pull back, pull back into a support zone. We're at the top of the zone. You're printing a reversal bar today. It's one to watch or trade. SLB, similar thing, down to the top of the support zone. Airbnb is an interesting one because it was getting some pretty decent call flow last week that I noticed when it was up here, and now it's even lower than that. So not a perfect looking chart. It's not a bull flag. It's not an inverted head and shoulders. There is one down here though. Look at this. So here's your inverted head and shoulders. A lot of folks were pointing this out and trading it. And now we've come back to test the neckline. Is that a good setup? Yeah. Yeah, it's a very low risk setup. So your assumption here is the neckline will hold. It's going to bounce up higher from here and complete the pattern. The pattern probably puts it up at 160 or so. And you can hold a tight stop. I would put it just under 120. I would put it right around 124. Lastly, Groupon. Tiny, tiny little float. Like 30 million shares. That's all that's available right now to the whole market. And it had a huge rally up on earnings, has come nowhere near to closing that power gap on earnings. So that's all good. And it's trading in, I mean, it's a beautiful uptrending chart. The MAs are all in the right place. I don't know what else to say. Oh, this is the other thing. The short float, right? How many shares of that tiny little float are short? It's like 30%, which is huge, huge. Most stocks are like 1 or 2%. So what does that mean? That means if it starts to get a little bit of upside to the north, you're going to have all those shorts scrambling to cover. You're going to get a squeeze like we saw here and here and here on earnings. Another squeeze move is coming. You may want to jump on this before it gets away too far. All right, guys, I got to let you go. God bless everybody. Have a great rest of the afternoon. I will produce this video after I meet with the other room, and then I'll send a link into the main room, both rooms, for your viewing pleasure. God bless. Bye for now.